My neighbor Jessica, she's 29, works as a marketing manager in Denver, made the worst financial decision of her life on the best day of her career. March 15th, 2022. She just landed a promotion with an $18,000 raise. Her first thought wasn't about investing or saving. It was about finally upgrading her apartment. Within 2 weeks, she'd moved into a place that cost $800 more per month. She felt smart. She felt successful. She felt like she was finally living the life she deserved. Here's what Jessica didn't realize. Her brain had just activated the same neural pathways that kept our ancestors alive 50,000 years ago. And those pathways were about to cost her $47,000. I know because I made the exact same mistake when I was 26. I got my first real job after college. $52,000 a year felt like winning the lottery. Within a month, I'd bought a new car, moved to a better neighborhood, and started eating out 4 nights a week. My brain was screaming success. My bank account was screaming something else entirely. Look, here's the thing most people don't understand about money decisions. Your gut instincts about risk, reward, and value were calibrated for a world where humans lived in small tribes and worried about where their next meal was coming from. That wiring served us well for millennia. But it's financial poison in 2024. Let me show you exactly how this works. When Jessica got that raise, her brain released dopamine. Same chemical that fires when you eat chocolate or get a text from someone you like. Her ancient wiring interpreted more money as more resources, which meant it was time to signal status to the tribe. Bigger apartment equals higher social standing. Makes perfect evolutionary sense, except Jessica wasn't trying to attract a mate or intimidate rivals. She was trying to build wealth, and those are completely opposite goals. Think about that for a second. The behaviors that helped humans survive for 200,000 years are the exact behaviors that destroy wealth in modern markets. Here's where it gets really interesting. Researchers at UCLA tracked 3,147 investors over 8 years. They wanted to see if there was any correlation between how smart someone's financial decisions felt and how profitable they actually were. The results were stunning. The investments that felt most obviously correct to people's intuition underperformed the market by 3.2% annually. The investments that felt uncomfortable, risky, or counterintuitive outperformed by 4.7% annually. Your gut feeling about money is not just wrong. It's systematically wrong in a predictable direction. Now, why does this happen? Your brain has 2 systems for making decisions. System 1 is fast, automatic, and emotional. It's the voice that says, buy the dip when stocks crash, or this time is different during bubbles. System 2 is slow, deliberate, and analytical. It's the part that can look at a 40% market crash and think, historically, this is when fortunes are made. The problem is, System 1 runs on autopilot 95% of the time. And System 1 was designed for a world where immediate threats mattered more than long-term planning. When the market drops 800 points in a day, System 1 doesn't see an opportunity. It sees a saber-toothed tiger. And what do you do when you see a saber-toothed tiger? You run. I learned this the hard way in March 2020. The S&P 500 dropped 34% in 5 weeks. Every morning I'd wake up and check my portfolio, and every morning I'd watch another $3,000 disappear. My System 1 brain was screaming, this feels like an emergency. This feels like I need to do something. This feels like I should sell everything and hide in cash until it's safe. But here's what I forced myself to remember. In the history of the US stock market, every single major crash has been followed by a recovery that eventually reached new highs. Every single one, not most of them, all of them. My gut was telling me this time was different. Data was telling me this time was exactly the same. I didn't just hold, I bought more. That decision, which felt completely wrong at the time, returned 67% over the next 2 years. Wild, right? But here's the part nobody talks about. I didn't just get lucky. I had a system for recognizing when my primal wiring was hijacking my decisions. And you can learn the same system. It starts with understanding the 3 biggest lies your brain tells you about money. Lie number 1, more income equals more wealth. Jessica's raise made her feel richer, so she immediately upgraded her lifestyle. This is called lifestyle inflation, and it's why 78% of Americans live paycheck to paycheck regardless of income level. The truth: more income only creates more wealth if you resist the urge to spend it. That requires fighting against 50,000 years of evolutionary programming that says, resources are scarce, consume them now. Lie number 2, losses feel twice as bad as equivalent gains feel good. Researchers call this loss aversion. If I give you $100, you'll feel good. If I take away $100, you'll feel terrible. But the terrible feeling is about twice as intense as the good feeling. This is why people hold losing investments too long and sell winning investments too early. Your brain is literally wired to make the opposite of the right decision. Lie number 3, what's happening now will continue happening forever. During bull markets, your brain assumes prices will keep rising. During crashes, it assumes they'll keep falling. Psychologists call this recency bias. But markets are cyclical by definition. What's happening now is temporary. What happened over decades is predictable. Now, if you're someone who earns a decent living but feels like you're not getting ahead as fast as you should, this is probably why. You're not lacking intelligence or discipline. You're fighting against neural pathways that were designed for a completely different world. The good news? Once you recognize these patterns, you can start to override them. Here's the framework I use, and it saved me from countless expensive mistakes. Before making any financial decision, I ask myself 3 questions. First, is this what everyone else would do in this situation? If the answer is yes, I pause. Crowds are wrong at extremes, which is when the biggest money is made or lost. Second, how does this feel? If it feels obviously right, I'm skeptical. If it feels uncomfortable but logically sound, I pay attention. Third, what would I tell my best friend to do? We're often more rational about other people's money than our own. These 3 questions won't eliminate emotions from your decisions. That's impossible. But they'll create a buffer between your primal instincts and your bank account. And that buffer is the difference between reacting to markets and responding to them. Tonight, I want you to think about the last major financial decision you made. A stock purchase, a career move, a big expense. Ask yourself, was that decision driven by logic or by feeling? Be honest with yourself. Your wealth depends on getting this right.